This episode contains discussion of personal and corporate tax and property investing. The information shared around these topics is for informative and educational purposes only and is not meant to be taken as professional recommendation. Any decisions you take are your responsibility alone, and it is strongly advised to do proper research and consult a professional opinion where applicable.
Welcome to episode 2 of the Multinational Money Podcast.
Welcome to the Multinational Money Podcast by Millennials with Money. I'm Johnny, your host, and if you're interested in expat life, financial freedom, and making the most of global opportunities, then this is your podcast. I'm very excited to speak with this episode's guest, Joshua Tharby. Josh is a property investor and certified tax advisor who recently relocated from the UK to Dubai, and he has a tax consulting firm which helps UK citizens and residents lower their tax burden. And so with that said, let's get right into the episode. So Joshua Tharby, welcome to the Millennials with Money podcast. Great to have you on.
Yeah, absolutely pleasure to be here. Looking forward to sharing a lot of tips today and hopefully adding some lot of value to your followers.
Yeah, I'm really excited for the conversation that we're going to have. So let's start with your background, Josh. Tell us a little bit about yourself.
Yeah, so in terms of kind of where I started, so first and foremost, our main business is basically accountancy, chartered tax advice, but helping other business owners pay less in tax. And of course, to do that, you need qualifications, you need experience. So that's kind of a large part of my background. Going to university, completing kind of AAT qualifications, completing the Chartered Tax Advisor qualifications for pretty much the best part of a decade now, starting to make myself feel old. My life has very much been focused around accounting and tax, studying it, getting experience. But prior to that, I've always been interested in entrepreneurship. So when I was kind of 12 years old, I was buying computers on eBay, kind of pallet loads of 20 or 30 computers, fixing them up, selling them on with Windows XP and a keyboard. At school, I was selling sweets. I was basically always trying to find something to do to basically make money, because grew up in a kind of a relatively poor household. Of course, we had a house, food on the table, so we weren't poor in that respect. But you didn't really have, or we certainly couldn't afford anything over and above that. So if I wanted something, a new games console or a PlayStation, something on those lines, there's no way my mum was going to get it for me. So I had to find a way to actually buy that myself. And that's where I started selling sweets at school, started refurbishing computers or whatever it was, started doing car boot sales at kind of 15 years old, just doing whatever I could to try and find something, usually buying it in bulk, selling individual pieces, and as a result make a profit.
Yeah. And is that how you kind of came up with the idea for your own tax consultancy firm when you got your qualifications?
Well, yeah, it kind of is. My mum basically said you need to carry on with education. You need a proper skill, basically. You need some kind of skilled profession so that you can fall back on. It's kind of a case of, well, I didn't really have anything, so I started looking, if I've not got my own killer business I'd do at the minute, well, what else can I do? Okay, let's become an accountant. So you are getting involved in the finances. To run a good business, it's good to have that financial accounting background. So I thought, actually, let's give this a go. Let's go to college, let's do accountancy. I knew that, in the long term, you can start your own accountancy business if I don't do anything else. So as a case of actually, I didn't have a good business idea, so therefore let's get some skills, and accountancy was just kind of that's where I fell into.
Yeah, finance is a good one. Obviously, I'm in finance myself, and you get to see a lot of areas of a business and see how it works, alongside obviously your everyday tasks that you do working with numbers. So it's nice.
Yeah, absolutely.
And so from your work as a tax consultant, what brings you the greatest satisfaction in terms of what you do?
It's definitely kind of just got to be helping people pay less in tax in terms of what that does, because from a selfish point of view, if we've done that to a client, obviously means that we're getting paid a fair amount as well. Obviously, the more tax we save somebody, the more we win as a business, but also the value and results that we deliver to them personally. So it's actually seeing them, finding them a way to save an extra £20,000 a year, which then means that they can go on their family holiday, or trying to find a way that we can help them invest so that they can leave their business or sell their business that they don't really like and have passive income. Basically, just help people achieve their goals and what they otherwise wouldn't be able to through the tax planning and accountancy side of things. That's definitely got to be the biggest win.
Yeah, absolutely. So Joshua, a lot of your content is about the UK and Dubai. You relocated to Dubai. What was the reason behind your relocation to Dubai?
Taxes. So that was one of the biggest ones. I guess it wasn't just solely based on taxes. It was a case of there's a lot more opportunity out in Dubai as well. Taxes, opportunity, and weather. They were probably the main three ones. In the UK at the minute, which is where a lot of listeners are based, it's probably a couple of degrees, probably raining. Whereas in Dubai today, 29 degrees, pure sunshine, and it's like that a lot of the year. So it's just a lot nicer lifestyle, a lot more active. You're eating outside. And ultimately, it's just a much higher quality of life. But then when you pair that with the tax savings, so Dubai's recently introduced a 9% corporation tax, but it's still completely income tax free. So you compare it to the UK when you have a kind of effective marginal tax rates up to 60% in the UK. In Dubai, absolutely zero income tax. So for a lot of people, what that allows you to do is effectively either double the quality of your life because you're not giving half of your income over to HMRC and taxes, or actually start to build substantial wealth without having to work any harder. Or what a lot of people do is they move out to Dubai and basically semi-retire because you're not paying those taxes. You don't need to work half the year just to pay the tax man. You can effectively take 6 months off and maintain the same quality of life that you do in the UK.
Yeah. And I think another question I have is a lot of kind of entrepreneurs and people that we see who are in Dubai, they seem like very wealthy business owners making 6 or 7 figures maybe. Kind of modest entrepreneur or kind of an entrepreneur with modest income still move to Dubai and live out there, with a reasonable quality of life, do you think?
Yeah, I'd say you probably, for the equation to even look at break, you need to be making about £100,000, I think, net profit is kind of where the break-even point is, because Dubai can be really expensive in terms of, the cost of living. If you want to live in a good area in Dubai, it can be quite expensive. Small things like deodorant in the UK, that probably costs you £2. Well, actually, if you want the same deodorant here, it's going to cost you about £5 or £6. There's kind of small things like that where it's a lot more expensive. So I'd say about £100,000 is really where you kind of break even in the tax savings against the extra increased living expenses. But if you really want to kind of be over here, be tax motivated, have a good quality, a real high quality of life, you probably do need about £250,000 a year to live out here.
Yeah, that's fair. I think Dubai is almost becoming like the modern day American dream, where it was once, move to New York, for example. Now everyone is wanting to move to Dubai.
Absolutely, I agree with that.
Yeah. So we talked a little bit there about why Dubai is kind of the place to be for expats right now. Any other reasons that you'd add to that? And you mentioned the 9% corporate tax as well. Do you think that'll affect Dubai standing in the future?
Yeah, I think it will in the kind of the long term, simply because actually there are potentially more attractive options, especially from a corporate point of view. Because what a lot of people, without getting too much into the tax stuff, you can have corporate residents and personal tax residents. So it used to be just a case of setting up a company in Dubai, having your corporate base here and your personal income tax base here as well. Whereas now what a lot of people are having to do is maybe have a company in the Isle of Man, the Channel Islands, and then still have their personal tax residency here, so separating it out. Whereas previously Dubai was basically a one-stop shop for everything. But from what we've seen with the 9%, it's still a lot less than anywhere in the Western world, and a lot of people don't actually pay that, because what a lot of people don't know is actually salaries are still tax deductible, just as they would be in the UK. Well, that's fantastic, because if you pay yourself a salary, you're saving the 9% corporation tax. Of course, you don't do this in the UK because the income tax is there. But actually, if there's 0% income tax, of course, the salary you pay yourself has to be market value, but you pay yourself a salary high on the top end for what you do. Actually, most businesses don't end up paying really much corporate tax because they're taking it all out of salary.
Yeah. Okay. Were there any countries that you were looking at as well as Dubai, or for your clients, are there any other countries that they're looking at besides Dubai?
Yeah, I'll be honest, I didn't really
or the UAE?
I didn't really look at too many countries. I didn't look at any countries, really. It's just a case of I come to Dubai on holiday, kind of looked a little bit about the tax and thought, let's move. I had no intentions of really leaving the UK until I had come to Dubai. But in terms of what clients go for, there are quite a few different options. Cyprus can be a great option. Actually, Malta, Monaco can be a great option. That's quite often the kind of European millionaires tax haven. But then Monaco is very, very expensive. You're looking at hundreds of thousands of euros in rent just for kind of a one-bedroom apartment. And there's not much to do. So I think for a lot of people, Dubai is probably the best option because it's almost the cheapest tax haven out there. If you look at kind of Cayman, well, you need something like $2 million to invest there, and you're the completely other side of the world, very remote. Monaco is ridiculously expensive. Well, Cyprus is probably not that much to really do there. It's not really, unless you're kind of settling down there. If you're a young person there's not many, there are some bars and clubs, but it's nothing compared to Dubai. So Dubai kind of has everything you need, and you can get a company set up here with visa, residency permit for less than £10,000.
Yeah. Cool. So this next part, we're going to look at kind of strategies for UK citizens or UK residents to optimize their tax. Obviously, this is not tax advice, but if you do want personalized advice, then Josh is a good person to go to. From kind of a big picture perspective, what are some of the strategies that, you know, the likes of digital nomads from the UK or people from the UK with a property business might use to lower their taxes if they're going to Dubai or somewhere else in the world?
Yeah. So like I say, it all depends on the biggest one is if you are looking to go international, looking at the structure, because if you still own properties in your own name, then actually, no matter where you're located in the world, you would always pay tax in the UK on those UK located assets. So it doesn't really give you any freedom or flexibility to change that taxable. Literally, whatever your rental profit is in the UK, pretty much that's what you'll pay tax on. But if you've got a limited company, and actually you've got those properties in a limited company, that limited company, just as if you're a UK resident, that can pay you a salary. And then, you know, as we spoke about a minute ago, the good thing about Dubai is 0% income tax. So actually, if you pay yourself a good market value salary from your UK property business, which if you've got a good hard number of properties, a large portfolio, it could easily be £50,000, £60,000, because that's what you'd have to pay somebody else to actually do your job. That can be completely offset against profits in the UK, saving you up to 26.5% corporation tax now. And if you're in Dubai, 0% income tax. So that could be a massive win just by having that right structure. So if you know that, okay, we might be going overseas in the future, well, actually, let's look at, can we put the properties we've got into a limited company, or should it be starting off with a limited company? Just because that's going to give you that flexibility later on down the line.
Yeah. Let's come back to this point about salary at market value, because obviously in the UK and in Cyprus as well, since we mentioned it, there's kind of a tax-free allowance. Do people ever pay themselves up to the tax-free allowance and then pay out the rest in dividends? Or is the market value concept that you mentioned something important that someone should keep in mind?
Yeah, quite, like paying out the tax-free amount and the rest of dividends, that's usually the best way to go for a UK resident. Simply because when you go up and above that personal allowance, well, you pay national insurance, you pay income tax, and ultimately the cost of the income tax and national insurance is more than the corporation tax saving, so it doesn't make sense. But if you're non-resident, you don't usually pay the national insurance, you don't usually pay the income tax, so actually because you get that tax-free, it just makes sense to take the highest possible salary. And the reason I kind of caveat it with the market value rule is because a lot of clients say, oh, Josh, I could just take all my profits out of salary, can't I? And I say, well, actually, you can't. Because, hey, you can't just do that because you'll be blatantly avoiding tax. HMRC will come along and say, hang on a minute, that salary is excessive. So you have to make sure that anything you do, especially when it's between yourself, connected companies, or yourself as an individual, it's all kind of reasonable, it's all above board, and it's market value. What would you pay somebody else to do your job? And as long as you can document that, prove that to HMRC, it's reasonable for you to pay yourself that.
Yeah. Okay, that's good. In the previous segment, we talked about corporate residents and personal tax residents. So when we think of digital nomads, that's obviously something that'll be applicable for them and if they have an entity. Is a UK limited company an option that digital nomads from the UK could use, or are there better options, do you think, better places where they can set up an entity?
Definitely much better options. Unless you actually need a UK limited company, there's no reason to have that, because you'd literally just be kind of voluntarily paying UK taxes. In terms of better options out there, Isle of Man company would be a great option. A Dubai company could still be a great option. Depending on where your clients are based, maybe somewhere in the US, an LLC, kind of something along those lines. But for most people in Europe, or even kind of Asia as well, a Dubai company is a great option for a digital nomad, or Isle of Man.
Yeah. And what would be the cases when someone needs a UK limited company? Would it be if they have clients or business interests in the UK?
That's usually the case. It's clients come to us and say, well, we might be dealing with government contracts. We might want to give a kind of a more reputable front. We're kind of dealing with kind of highly sensitive businesses, established businesses. And if you send them an invoice from a Dubai company for, $100,000, you kind of people might sit on the fence a little bit. Whereas if you've got a UK limited company that's established, you can see the accounts at the company's house. For people doing business in the UK, it just gives you that little bit extra peace of mind.
Yeah, I guess maybe from a data protection perspective as well, having
Yeah.
an entity based in the country as well can be, yeah. Okay. What is the biggest mistake that people often make in terms of taxes when they leave the UK?
I guess the biggest one, especially the biggest one, I'll say when people even stay in the UK. So a lot of people come to me and say, Josh, okay, I want to set up a company in Dubai. I want to stop paying corporation tax, basically. I even had some clients come to say, I want to elect not to pay corporation tax, as if that's even something that's an election that you can make. They're kind of under the impression that they could set up a company in Dubai and run it from the UK. So literally just run it up, start sending all their invoices, start taking strike payments, basically not paying taxes. But what a lot of people don't know is actually if you are basically the directors and the shareholders of that business and you're a UK resident yourself and you run that whole business from the UK, HMRC, although the company is located in Dubai, will actually argue that that company is tax resident in the UK and fully subject to corporation tax. So that's probably the biggest mistake that I see people make kind of generally above, well, kind of big picture. We've had so many people that have come to us and said, oh, well, you know, we've already done this, what can we do? We've had to kind of fix it and kind of come clean. We've had a lot of people that said, oh, actually, I'm going to just take the risk and kind of everything like that. But ultimately, when HMRC do find out about that, you will have kind of massive penalties and interest to pay, all the corporation tax going back. So it's a case of if you are going to do that, make sure that you're not a UK tax resident, because if not, you will basically get yourself in hot water later on.
Yeah, good point. Because permanent establishment and CFC is very, very complicated legislation.
And then I guess to actually answer your question, in terms of people leaving the UK, I guess make sure that you are comfortable with how long you can spend in the UK, and so much that you actually are non-resident. Of course, the statutory residency test is it's a complicated exercise. Whether you're kind of automatic overseas, automatic UK resident, or looking at a sufficient ties test, it can be complicated to actually work out how many days you can be in the UK and be non-resident. Because if you go 1 day too many, you might think, okay, it's only 1 day, it doesn't make any difference. Whereas actually, when HMRC pick up on that, that 1 day will be a difference between paying UK tax or just your UK source income. So for a lot of people, no tax, or actually paying UK income on your worldwide income and gains, which is basically a complete nightmare and everything is taxed. So you've got to be really careful to make sure that you are counting the days and you don't go anywhere over.
Yeah, I made a video about this, and the sufficient ties test, it's very complex, and there's so many ways that they can get you in terms of making you a tax resident.
What people don't realise is just one of the accommodation ties. So if you've got a parent or brother or sister who say, you know what, Josh can stay around whenever he likes. Well, actually, that counts as a tie, which is absolutely absurd.
Yeah, I spotted that when I was making the video, and I was like, whoa, okay.
It's even a case of, because of the way the legislation is drafted, if you were to stay in the same hotel for more than kind of 30 days continuously, actually staying in a hotel could count as an accommodation tie. So we said to clients, well, actually, to be 100% safe, do not stay in the same hotel for more than 30 days, because that might count as a tie.
Yeah. Wow. Okay, Josh, so we talked about kind of tax planning, we talked about Dubai a bit. Let's talk about property, which is the other thing that you're quite deep into. So how do you get started in property, and what is kind of your property strategy? Is it like BRRR? Is it buy to let?
Yes.
What is your approach?
How did I get started, or how should somebody get started?
How did you get started?
So I bought my first property. That's basically it. The kind of long and short of it is, first property was a BRR deal. So buy, refurbish, refinance. Well, I did actually refinance that one. So it's literally kind of almost a buy, refurbish. And then I was sneaky at the time. I did it on a normal buy-to-let mortgage rather than kind of bridging all cash. So I basically waited 2 years and then refinanced because I could afford to leave the cash in. So I wasn't too worried about that side of things. Literally bought my first property. It was a BRR deal. Still got that property to this day. It's fantastic income. In terms of actually cash in the property, now I've had that property a number of years. I've got all of my cash out of it. So each time that tenant pays me their rent every month, it's literally free income. And BRI is still kind of the strategy that I do. I love it. Love it the most. I pursue it the most. I do kind of dabble just standard buy to let sometimes if it's a good deal. If you do get a good return on capital from it. But really, if you want to make your money work as hard as possible, BRI is what allows you to do that, and even property development as well.
Yeah, nice. And so after you bought your first property, it was just kind of a snowball from there. You went and bought next one,
Yeah,
and then end up with a business.
exactly that. It's just a case of, because what we've done is we've got our main business in the UK, JSM Tax, the accountancy and tax business. I pay a wage myself out of that, and then anything else that literally goes over to the property investment company each month. So every couple of months we can just buy another one and then another one. All of the profits continuously build up as well in the property investment company. So literally every couple of months we can just either get another BRR deal, or if there's nothing about at the time, we'll just get a good high yielding buy-to-let investment and just continuously build it up.
Yeah. Nice. And since you asked, how would you suggest someone get started in property investing in the UK?
I'd say first, I'll just try to accumulate a decent pot of money, because so many people try and start with no money or kind of scrimping together, whereas actually just focus on building a large pot of money first, because that's the hardest bit to do, and that is going to give you, it's actually going to make property investments so much easier, rather than trying to borrow money, find investors, go on all these courses and spend your money there. Actually, just, there's so much free information out there when it comes to property. It's really, I've not done any courses. It's really not difficult what you're doing. You're buying a house, you're doing it up, you're either selling it or refurbishing it. It's pretty straightforward. You don't need to go on any courses to learn that. And I'd say just try and accumulate a decent pot of money, minimum, £25,000-50,000, save that up. Because if you really kind of scrimp to get the property, but actually something goes wrong, there's an extra cost that you didn't know about, it could kind of really ruin the whole thing and actually put you off doing property long term, which does build wealth, but you have to have a little bit of money to get started the right way.
Yeah, it's an interesting piece of advice, because for pure transparency, I have 2 storage units here in Spain, which I rent out. And, it was very little money to get started, less than 20 grand.
Yeah.
And, it's a good first kind of baby step into property investing. But like you say, it is kind of, just scraping in little bits of money here and there, maybe a different approach. Would be, like you said, to save up a decent bit of money and then, make proper money from a decent investment. Good advice.
Yeah, it's just, I guess it's, especially where I'm from in Peterborough, I guess properties are kind of, £150,000-200,000. If you're looking at areas up north in the UK where you can actually get properties for 40-50, well, actually that advice that I said there isn't probably not the best advice, because it's not strictly true, because you could probably half that advice. If you've got £15,000 or £20,000 and you're working up north where the numbers are a lot cheaper, that's going to be a lot of money relative to the property prices and the cost of opportunities in that area.
Yeah. Cool. So at what point does a company structure for someone with a property business in the UK become beneficial?
Usually as soon as they're a high rate taxpayer at the minute. That's really the biggest benefit. If you've got other income, so if you've got employment income, business income, that pushes you into that high rate tax band, and essentially you're paying 40% tax on the business of the profits of your property business. Of course, mortgage interest relief, you only get 20% basic rate tax credit. So as soon as you got anywhere near that higher rate band, well, actually most people, that's when a limited company makes sense.
Yeah. But is it easy to move properties from kind of personal ownership to a company ownership? And is there any costs associated?
It can be in some cases. So in order to do it tax-free, you basically have to be in a partnership already, which usually means kind of husband and wife owning properties jointly. And you have to have enough properties to be able to show the HMRC that you've got a property business so that you can get incorporation relief, which is basically where the capital gains gets held over. Because the default treatment on transferring property from your own name to your own limited company is basically you've disposed of them, so you have full capital gains tax due, even though you've not got any money. And the company will actually pay stamp duty based on the full market value of all of the properties. So when you factor that in, for a lot of people, it can be very prohibitive to actually incorporate because of those initial upfront costs. But if you do have a property partnership, there's actually kind of rule quirks in legislation that say you can incorporate without stamp duty. And as long as you've got enough properties to be able to show that you work at least 20 hours a week, that's the kind of result of the case, the Ramsey case with HMRC, 20 hours a week in your property business, then you can incorporate capital gains tax free. So if you fall within that kind of framework there, yeah, it's pretty cheap, easy, straightforward to incorporate. If you don't, then that's when it's a little bit more complicated and expensive.
Okay. And it's probably something you maybe need to think about at the start as well if you're doing it by yourself, if you are going to just get a couple of properties or if you're going to really try and build a business.
Yeah, exactly that, because even with the mortgage interest rates, still in limited companies, you're probably looking at 0.5 or 1% more expensive. Accountancy fees are a lot higher. it can be more expensive to kind of get the money out of the company if you're a basic rate taxpayer compared to having it in your own name. So if you do usually want a couple of properties and you're dabbling it, you might still be better off in your own name. Whereas if you do want to build something big and actually kind of grow it into a large long-term pension investment vehicle, then a limited company might be a better option.
Yeah. Cool. So you're kind of proof of the next question because you have a property business in the UK. So a UK property business can be run from abroad. How would someone go about doing that? And how would they optimize their tax structure when running a property business from abroad?
Yeah, I'll be honest, it can be run from abroad, but what I found challenging, completely transparent with you guys, is actually growing it whilst you're abroad. Because you have to rely on basically other people to do the viewings, manage trade, kind of things like this. Originally where you're a bit hands-on, especially in a BRR property portfolio, actually it's quite active. You need to be on the ground, especially finding deals and managing the projects you've got on. So it's definitely easy to manage it because, to be honest, when you actually got a property portfolio, you have a letting agent most of the time. Certainly I do, and actually they manage it. It's sometimes, okay, they might get an email, something's gone wrong, there's this leak, and I just say, okay, send a tradesperson over, get it sorted. I don't care, I just want it easy. I want to kind of be hands off on this. So actually managing it is very easy from abroad. Growing it in the early stages and actually kind of buying more properties, you do probably need to be in the UK a little bit for that. So you have to kind of factor that into the time that you're spending viewing properties and completing on legals. But then how would you manage that for tax? I guess as long as you're in a limited company, as I mentioned earlier, that's the best way of doing it when you're non-resident. Make sure you're a limited company, and the best way to optimise it is to pay yourself out a salary if you're in a country such as Dubai where it's tax-free, because that can wipe out a good proportion of your profits, which would otherwise be subject to corporation tax.
So, Joshua, thank you so much for some great insights that you've given us. I want to finish on a fun question, which is something that I'm going to do with every guest on the podcast. And it's, when you're back in the UK, is there anything that you can't get in Dubai that you really miss?
Oh, honestly, there's a list. I don't even know if I've got. I don't even know if I've got a little list in my notes of just kind of. I'm going back to the UK in 2 weeks. A little agenda of. So yeah, where do I start? So the first thing we've got lined up, Domino's Pizza. Domino's Pizza in Dubai is absolutely rubbish. It's just completely different. So that's definitely one of them. Yes, mostly food related. Funnily enough, especially with it being Dubai, a lot of it's kind of pork products that you miss, nice bacon roll, a nice sausage roll, all of that kind of stuff. Greggs. You wouldn't think you'd ever see in a position where you say you miss Greggs, but yeah, nice steak bake. It's mostly food related that you miss. Of course, other thing I'm looking forward to as well, my house in the UK. Fantastic house. It's nice to go back to there. But yeah, there's a lot of food in the UK that you can't get in Dubai. So that's definitely what I miss the most. Yeah.
What do you think of Nando's in Dubai?
Nando's in the UK is so much better. The menus, it's very similar here, but what I find is I think the quality of the chicken in the UK is actually better than Dubai. So it might be that if you've got the chicken thighs over here, they're very kind of chewy. Whereas in the UK, I've got a good order, 4 chicken thighs, hot. If you're feeling hungry that day, you'll get the garlic bread, the chips, and the coleslaw. That's the big order. But you just can't get it over here. The coleslaw over here is not as good. The garlic bread's not as good. The peri chips aren't as good. So yeah, I'm looking forward to a UK Nando's.
Yeah, all my friends when I go back, they're like, Nando's is old news, but there's no Nando's in Spain. So for me, every time I go back to the UK, I try and get a Nando's. You would be one in Spain. Yeah, so there's nothing. There's probably equivalents or something similar. I was in Portugal recently as well. They have a lot of similar Nando's food because it's
always similar, but it's never the same. The way the Nando's, it's done in the UK, they've got it's just perfection every time. I think it's because you eat it so much, you grew up eating it. Actually, even if I guess it's not right or wrong. It just feels like that's how it should be done because that's how it's been done historically. That's how you look at it. Whereas actually somebody coming from Portugal would come and eat that and say, hang on a minute, this isn't quite right how it is at home.
It's true, yeah. Nice. Perfect. So Joshua, thank you so much for everything that you shared. Very helpful. Be sure to check out the video description to check out Joshua's channel as well.
Perfect. Pleasure for having me on.
Thank you for watching this episode of the Multinational Money Podcast. I hope you found it helpful, interesting, and inspiring. Be sure to check out Joshua's channel. I'll leave his link in the video description on YouTube and in the episode notes on podcasting platforms. Guys, if you'd like to support the podcast and support Millennials with Money, then you can do so by signing up through one of the membership options, either on YouTube or on Patreon. And in return, as a thank you, you'll get the opportunity to find out who the guests are ahead of time, and if you'd like to, submit a personal question for the guest to answer to you personally, with the answer being shared in a private forum. Till next time, I'll see you on the next one, and let's get this money.